Welcome to the third video of the complete learning series of stock market investing and trading. As always, I've put all these videos into a single playlist. I've given the playlist here on the I button above. Make sure that you watch all the videos, watch them in order, learn really well. Let's trade together and grow together. So I hope you watched the first two videos of the series, and I hope that you have your perspective really set well. If that is the case, now it's time to start learning. Right? Let's get started. So in this video, the agenda is to understand the absolute basics about the stock market, and it is not an easy task at all. So for doing that, we have to take a story, an illustration, an example, and then hear the story and then understand all that is there to the basics of stock market. So the agenda is very clear. We are going to understand why the stock market exists. Then we are going to understand what is the stock market. Then we are going to understand how does the stock market work. So as I said, we are going to take a story and then we are going to understand all these important concepts. That is exactly what we are going to do in the video. So before entering, let me re-establish some things for you. So we are embarking on a learning journey. So this is just the beginning. We are probably 50 more videos coming up ahead with all the deep concepts about the stock market in simple plain English. So since we are going to do that, I want your complete intent and effort. What I'm trying to say here is stock market is no rocket science. Any common man, if you put in the right intent and the right effort, then you can also understand about this, you can learn about this, you can also start making money by investing and trading. So yeah, let's get started, right? So what are you waiting for? Mark your attendance down below. Take your notebook and start making notes, and let's start learning. Before entering into the video, if you are someone who understands the basics about the market yet not making profits in the market, then download marketfeed app right now to get the trading ideas of India's top profitable traders absolutely for free, to join their live trading sessions and also to learn their secret trading strategies directly from them. So yeah, I need your full focus and attention. Watch the video completely. Without further ado, let's get right into it. The name is Sharique Samsudheen. Welcome to marketfeed. Welcome back to our very own classroom. I know you're already looking at the board, already trying to read all of these and probably are also intimidated by all this data. Let me tell you, do not worry. Do not even try to read everything together, because in this video, I'm going to tell you a story. And in the course of the story, we'll be touching upon each of these points, and when we reach there, we'll understand that. Okay, so be with me in this journey and let's learn together. So the first point to understand about this picture is we have stock market at the center, and then we have a lot of other people here in red boxes. Who are these people? These are the different participants in the stock market in the red boxes. Now, when I speak about the different participants in the stock market, the largest problem there is everyone speaks about the market, or everyone approaches the market only thinking from the perspective of an investor. So investor, I have just used the term here. By investor, what I mean is stock market participants. So always, whenever we hear someone speaking about the stock market, they always talk about it from the perspective of a stock market participant. But is that it? So we have come here to learn. So we have to understand about all the important participants in the world of stock market. So all of these people in the red boxes are the different participants or constituents of the stock market. And in the green box, we have stock market here. So I hope you have a basic understanding or structure about the picture here. Now, as I said, everyone speaks about the stock market from the viewpoint of an investor or a stock market participant. But that is not enough. We have to understand the complete picture or the complete story, right from a company forming, deciding to raise money from the public, getting listed in the stock market, coming into the stock market, people putting their money into the company, people exchanging shares in between, and who are the people facilitating that, who is regulating that, everything as a story we are going to understand in this video. So by the end of the video, as I said in the beginning, you'll understand why the stock market exists, not just for the investors, but for the whole ecosystem. You'll also understand what is the stock market. You'll also understand how does it work. Okay, so let's get started. So the first question that we are addressing is, what is the stock market? So let's take the dictionary literal definition first, and then let's get into the story and start understanding. So the literal dictionary definition says that stock market is a place where shares of publicly listed companies are traded. Let that sink in. Listen to it. What is it? Stock market is a place where shares of publicly listed companies are traded. So if you can think about it, picturize a building. Picturizing always helps in learning, okay? Picturize a building, so it is a place. Okay, that is stock market. Stock market is that building where shares of publicly listed companies, so that is the commodity which is being traded. What does trading mean? Someone is buying a share of a publicly listed company, someone else is selling a share of a public listed company. So a lot of trades are happening of shares of publicly listed company between people. So it's more like a market, thereby called the stock market, right? So yeah, now in this definition, what is it that you're not understanding? Shares of a publicly listed company. Okay, so let's start understanding our very first participant in our story, which is publicly listed company. So again, in the definition, what you have to understand is shares of publicly listed company. So let's understand what is a publicly listed company and what are shares of a publicly listed company. Now this is where let's start taking the story or hearing the story, right? Now, I'm going to tell you a story about a supermarket owner from Jamshedpur. His name is Jignesh Bhai. Okay, Jignesh Bhai from Jamshedpur, who owns a very well-reputed supermarket in Jamshedpur. So basically, I've done my education, my college from Jamshedpur. So I thought when discussing the story, let me take Jignesh Bhai from Jamshedpur only. So he is running a good supermarket in Jamshedpur for the last 10 years. Business is doing well, good revenue. He's making good profits as well. Everything is going well for him. In fact, the business has a good goodwill as well. Now, there are two things that you should understand when it comes to a business. What are they? Number one is ownership of a business. Number two is valuation of a business. Now, if you look at Jignesh Bhai supermarket, what is the ownership of that business? Jignesh Bhai started the business himself and he is running it completely by himself, which means that 100% ownership belongs to Jignesh Bhai only. Correct? Then let's talk about valuation of a business. See, everything and anything has a value attached to it. Correct? Likewise, a business also has a value, or it's called the valuation of the business. And why not? It is a business, or it is something which is generating money for somebody. It has been there for 10 years. It has this much revenue. It's generating profits. So Jignesh Bhai supermarket also, we can put a valuation to it. Now, since we have taken the story as an example, let's also take some numbers to make things a bit more interesting. Let's say Jignesh Bhai supermarket is making rupees 5 lakhs as profit every month. So, just for an example, let's also say that the valuation of the business is nearly 1 crore rupees. Okay? So, two things I said for a business, right? One is ownership, 100% with Jignesh Bhai. Then there is valuation, 1 CR, and that is completely owned by Jignesh Bhai. Okay, now he is getting old, he is moving ahead, and he feels like, I need a partner. I need an equal partner who can join the business, own 50% of my supermarket, also takes care of all the operations. Okay? He's looking for a working partner. Make sense? Okay, now he found somebody. That somebody is coming to Jignesh Bhai. Now Jignesh Bhai has to give 50% of the ownership of the business to that person. How can he give? Think about and let me know. How can he give 50% of the ownership to this new person? So that is where the concept of shares or stocks come into the picture. So what are shares or stocks? It's nothing but it's as simple as unit of ownership. Okay? Shares are unit of ownership. So Jignesh Bhai is saying that, okay, my supermarket, the entity has 1000 shares, which means that the supermarket, the complete valuation is divided into 1000 units, and each unit is called a stock or a share. Now there is some simple mathematics here. We said that the complete valuation of the supermarket is 1 CR. Now we also said that there are total number of 1000 shares or stocks in the entity. Then you tell me, what is the value of a single share? It's easy, right? Total valuation divided by total number of stocks, which will give you, I hope you can see the mathematics here, which gives you a value of rupees 10,000 per share. So if I'm rearranging the mathematical formulas as very easy, a company's valuation is equal to total number of shares into value of each share. I hope this is very clear. The largest takeaway from this segment should be stocks or shares are unit of ownership. Okay, now let's get back into our story. Now this new person has come. Jignesh Bhai wants to give 50% of his business to this new person. What can Jignesh Bhai do? He can now give out of the 1000 shares available, 500 shares to this new person. And how can this new person buy this 500 shares? By paying the value of the 500 shares. So 500 into 10,000, which is 50 lakh rupees, right? So this new person is paying 50 lakh rupees to Jignesh Bhai. He is getting 50 lakh rupees. He is giving 500 shares of the company to the new person. Now 500 shares ownership is with Jignesh Bhai, 500 shares is with the new person, which means that in percentage terms, 50% with Jignesh Bhai, 50% with the new person. So as a side note, I said all of this only so that you can understand the concept of shares or stocks, which is just nothing but unit of ownership. Okay, now the story and the journey continues. Jignesh Bhai and his new partner, they are moving ahead with full strength. Business is growing, business is expanding. They've opened a few more outlets in Jamshedpur, so things are looking good. Now Jignesh Bhai is getting a bit ambitious. He wants to make it big. He wants to grow big. He wants to open 100, 200 outlets across India. So for doing such a large expansion, what does he need? He needs money, right? He needs capital. He needs money to set up all these 100, 200 outlets across India. So where can he get money from? Think and tell me. Where can a business owner find money from? The simplest way to do is go to a bank, give them your business proposal, probably give them a lot of collateral, and the bank will give you loan. This is called raising capital via debt. Debt is nothing but loan, right? So you can go to a bank and take a loan and use that money for capital expenditure for setting up this number of outlets that Jignesh Bhai wants to. But he doesn't want to go to a bank and go via the debt route. Why? Because he knows if this goes wrong, then he'll be in a debt trap, right? If he's not repaying the loan back, then banks will be on top of his head. He'll have to pay it back, or else it will go into an NPA, and probably all of his collaterals, his house and all of his wealth will go away. So he does not want to take the headache of going via the loan or the debt route. Then what can he do? Just like he found the new partner, right? He could go around Jamshedpur and the areas that he know and find people who are interested in buying shares from him and becoming a partner in the company. He can probably sell 1% each to maybe 10 or 15 or 20 people and raise money from so many different people. Now that's also a tedious task, right? To find that many people, to go and convince a lot of people, convince them his plan. It's also a very tedious task. Jignesh Bhai does not want to do that as well. So what does he do? Then he hears about the amazing world of stock market. He hears that if he converts his company into a public limited company, and if he lists his company in the stock market. Now, when he lists his company in the stock market, it's called a publicly listed company. We started the story for explaining this, right? So he heard that if he publicly lists his company in the stock market, then there are a lot of people across the country who would put money into the company. Okay, he wanted money, right? So all of these people would put money into his company, and in exchange, he would give a small equity ownership, or he will allocate few shares to these investors based on how much money they are investing. Now he hears this and he is interested. Now he goes and tries to understand what can he do so that he can convert his existing company, supermarket company, into a company which can be listed in the stock market. And then he hears that he has to do an IPO, an initial public offering. Okay, when he does an initial public offering, the term itself is very clear, right? He is offering the shares of his company to the public, initial public offering. So when he do that, his company becomes a publicly listed company, and it gets listed on the stock market, and people can give money in the stock market, and the money will go into Jignesh Bhai's hand, and these people will get the shares of the publicly listed company, which is Jignesh Bhai's company, right? To sum up so much about the story, what have we learned so much? Why do companies go public? And what is the answer? To raise capital which can fuel their expansion plans and also to give exit to the founders or early investors. What does the second point mean? For example, when Jignesh Bhai is offering some percentage of his company for the public to invest in, he is offering some shares which he owns also. So when public buys those shares from him directly via the IPO, that money goes into his hand. So he is basically being rewarded for all the years of hard work that he has put in. So basically the question is, why do companies go public? Two answers. One is to raise capital. Number two is to reward or to give exit to founders or early investors. Okay, so Jignesh Bhai Supermarket's IPO is done. Now it is listed in the stock market. Now in the beginning, we only looked into the actual definition about the stock market. Now we understand that it's a building and that is where stocks are listed and people can buy and sell shares of publicly listed companies there. Now let me be very specific here. There are two stock markets in India today. There were multiple stock markets in India earlier, but now there are only two stock markets remaining in the country. One is BSE, Bombay Stock Exchange. Number two is NSE, National Stock Exchange. So in the following videos, we'll definitely understand and learn more about these two stock markets. Now just understand that there are two stock markets in the country. So basically, a company, when going public or when doing IPO, they can decide which stock market to do IPO in. See, normally when we see most of the companies doing their IPO via both the stock markets, but initially there were multiple companies which did their IPO only on BSE and not in NSE. And for that reason, if you look at both the different stock markets, in BSE you can find more companies than NSE. Now, let's get back into the story again. So when Jignesh Bhai did his IPO, if you remember, he had total 1,000 shares in the company, out of which he decided to offer 15% of the total shares for the public, which means that 15% of 1,000 shares, 150 number of shares are being offered to the public via the IPO. Now, you might have a legit question here. Hey, Sharique, how many shares would there be in a company? Who decides that? Very interesting question. So when a new private limited company is registered in India today, normally we see the total number of shares are somewhere between 1,000 to 10,000. But that's again something the founders can decide. But again, when a company grows and moves ahead, it can issue more shares as well. Do not be worried by this. Do not get too deep into this. Understand this, that when a company goes IPO, you can see the total number of shares which they are offering and how much percentage of their total number of shares they are offering to the public. And keeping it very real, a lot of these companies in the stock market available today, you can see that they have lakhs or even crores of total number of shares. Again, let's come back into our story. So out of the 1,000 total shares of his company, he is offering 15% or 150 shares via the stock market by doing an IPO to the public investors. So if you remember earlier, the value of a share was 10,000 rupees earlier, right? After which his company has grown a lot. So at this point, when he is doing an IPO, the price of a share is rupees 20,000. Okay, that is the story, and it has happened via the stock market. Now let's understand the second participant, which are investors. So as I said in the beginning, I've just used the term investors here. This can include retail investors like us, like me, like you, like all the people around us. There can be traders as well. There can be foreign institutional investors. There can be domestic institutional investors. So all of the people who are participating in the market or who are putting money into the market for buying and selling shares of publicly listed companies, all of them come under the term investors. I hope you understand that. So the next question is, why do these people exist? We call them investors, right? But I said there are multiple people in there, including us. So why do these people exist and what is their objective? We should understand that. So these people come into the world of stock market to invest and grow their money. That is the largest objective. Let's think about it, right? So when Jignesh Bhai Supermarket is listed in the stock market, a few of these investors buy those stocks. At what price? At 20,000 rupees per share. So they put in 20,000 rupees. Now they wait for, say, 2 years. And in 2 years, Jignesh Bhai Supermarket grows a lot. When the company grows a lot, its valuation grows. When its valuation grows, the price of each share increases. So they bought the share at 20,000 rupees. So after 2 years, the share price increases to 40,000 rupees or 30,000 rupees. And then they sell the share. When they sell the share at 30,000 rupees, they make a clean profit of 10,000 rupees per share. Now, these are just examples. I hope you get the point here. So, these people, their objective is to invest in good companies, and when they grow, they can sell the shares of these companies at a higher price and make money from that. So, they basically investing their money to grow their money. That is the number one objective. Now, the second objective is to get dividend income. Very important concept. Let's understand what is dividend. So on a yearly basis, when Jignesh Bhai supermarket makes profits from its operations, it redistributes the profits to its shareholders. Correct? It only makes sense, right? A company distributing its profits back to its shareholders. So an investor, depending on how much of share he is holding, according to his percentage ownership, he'll receive a percentage of the profits. So for example, if Jignesh Bhai supermarket in a year is making 100 crore rupees of profit, the company's board decides to give back 10 crore rupees as dividend. So it's not necessary that the complete profit has to be given out as dividend. It's up to the company whether to give dividend or not. They can even decide not to give dividend at all. Some company decides that, okay, some amount we'll give back to our shareholders for rewarding the shareholders. So in this example, Jignesh Bhai's company, it is a good company. They have decided to give 10% of their profit, which is 10 crore rupees, back to its shareholders as dividend. Now, for example, there is one investor who has 1% worth of shares of Jignesh Bhai supermarket. So how much will he get? He'll get 1% of that 10 crore rupees, which is 10 lakh rupees as dividend also. So these are the basic two objectives why people, retail investors like us, invest in the stock market, which is to grow your money and also to get dividend income. Then there is also a third objective where there are a lot of traders also, right? They don't want dividend income. They don't want to grow their wealth over a long period of time. They just want to get in and out of stocks. For example, Jignesh Bhai's company stock is 20,000 rupees today, and maybe after 5 days is 20,100 rupees. So someone might buy it today, wait for 10 days, see that 100 rupees appreciation of the stock price, sell it there, make that 100 rupees profit. These people are called traders. So all of those people are constituted in this segment. So far we have understood why companies come into the stock market, right? They become publicly listed, they come into the stock market. Why? We have already discussed. Then there are investors and traders in the market. Why do they come into the stock market? That also we have learned. Now is the time to take some time and answer the very important question here. Why the stock market exists in India? Why does the stock market exist? Now you have the clear answer. Two answers to it, right? One is stock market exists so that companies out there in the country, they can come to the stock market, they can do an IPO, they can get publicly listed, and they can raise capital, and they can use that capital for their expansion. They can also give exit to its early investors and founders. Now that is one reason why the stock market exists. Story doesn't end there. Stock market also exists so that it gives an avenue for normal people like us to grow our money at a much higher rate than existing other investment avenues, right? If you invest in good companies, you can, as we learned in the second video, we can grow our capital at a rate of even 20% per year or 30% per year. Only the stock market offers us such an avenue. I hope now it is super clear why stock market exists. If you have understood so much, before moving ahead and understanding how the stock market works, we have to understand two more basic concepts. The concept of primary market and also the secondary market. Okay, let's get back into the story. So when Jignesh Bhai did the IPO, he offered 150 shares to investors, right? Let's take an example of 150 different individuals investing or buying one share each. Okay, now this happens during the time of IPO. What happened there? Each of those 150 people paying 20,000 rupees each, and the entire money going into Jignesh Bhai's hand or into the company's account. Correct? Now this transaction which happened here during the time of IPO is called the primary market, where the money paid by the investor is going into the hands of the company which is raising the money. That is called the primary market. Okay, if you have understood that, now let's understand what the secondary market is. So IPO is done. Now what is the scenario? The 150 shares is with 150 different investors. Correct? Now, another day, say 1 week, 2 weeks passed, there is another person in the market. He wants to buy one share of Jignesh Bhai supermarket. Where can he buy the stock from? Can he go to Jignesh Bhai for a stock? No, IPO is done. He has completely given out the 150 shares which he had planned to give out. So that's already done. The 150 shares is with the investors in the market. It's in the hands of 150 different people. So this new person, he needs a share. Where can he buy it from? He has to buy it from an existing shareholder here. Out of this 150 people here, he has to buy it from one of them there. So that transaction can also happen in the stock market. So this new person buys the share from an existing shareholder in the public space, right? And that is where this new person gets the share from. And this transaction is called the secondary market. Why? Because this new person is giving money, maybe 20,100 rupees. That 20,100 rupees goes into the hand of the existing shareholder and not into the hand of the company. You get that? This is called the secondary market. So when we see on a regular basis shares being exchanged or shares being traded on the stock market, that is all the secondary market that we are seeing. And when stuff is happening in the secondary market, how is the company getting benefited? How is the company getting benefited? Let's take the example again. Say Jignesh Bhai still holds nearly 300 shares of the company. So the price of the share of the company gets updated whenever a transaction is happening in the secondary market. So initially the price of a share was 20,000 only. Now because the transaction happened in the secondary market, the price gets updated to 20,100. So basically the value of the entire shareholding of Jignesh Bhai increases. His net worth increases. Now this is the basic difference of primary market and secondary market. So now I just said that the share price was 20,000 in the beginning. Then a transaction happened where the share price became 20,100. Then I also said that the share price for the entire company got updated to 20,100. There are some doubts here, right? Now the things I'm going to discuss now are the most basics doubt which I personally had when I came into the world of stock market, which is who decides the price of a stock? How is share price determined? And number two, why do share price keep fluctuating every single second? So when the market is open, if you look at say a Tata Motors for example, you see that the price of Tata Motors keeps changing every single second. Why does that even happen? How does that happen? So this is what we are going to learn now. So share prices are determined basically because of two reasons. Number one is the actual value of the company itself. See, we discussed this earlier, right? Any business, we can attribute a value to them based on the revenue, based on the profits they are generating, based on the goodwill that they have, based on their future perspectives, right? Future potential. Based on all of those things, we can attribute a valuation based on the actual performance of the company. So that is the actual true valuation of the company. And if we have the true valuation of the company, you divide that by the total number of stocks, you get the price of a single stock of the company. So in this case, as time passes, if the company starts doing well, if they start generating more revenue, if they start expanding a lot, if they start making more profit, then its true inner valuation will itself increase. And for that reason, the share price will also increase. Or just the opposite side of that, if with time the company starts performing really badly, it starts to make losses, then what happens? Its valuation will also go down, and for that reason, the share price will also move down. Now what we discuss is the single true real reason which determines the price of a stock. But that isn't it. We're not living in an ideal world, right? There are other things also which determine the price of a stock, which is very important to understand the concept of demand and supply. So when there is high demand for something which has very limited supply, the price will go up, right? Very basic logic. And just the opposite, if there is very less demand and the supply is really high, then the price will go down. I'll give you an example here. So initially, the price of a single stock of Jignesh Bhai's company is 20,000 rupees, and there are 150 investors as well. All of a sudden, there is some interest in Jignesh Bhai's company. People are more interested in it, and there are 100 more people in the market who wants to buy Jignesh Bhai's stock. But the stocks are already with 150 people only. There are 100 other people who want to buy it. So do you think it is okay for this 150 people to charge 20,100 rupees per stock? Won't these people be ready to buy? Because there is huge demand. There's some way they're trying to buy the stock from those people. So when these people are telling, okay, give us 20,100, won't they give? There is high demand and less supply only. Okay, so the transaction will happen, and transaction will happen at the rate of 20,100. What if the shares are with 150 people? There isn't a single person willing to buy, not even a single person willing to buy, and someone here wants to sell it. How can he sell it? He thinks, shit man, there's no one to buy. What can I do? Okay, then he'll put up an offer somewhere saying that, okay, I'm willing to sell this at 19,500. And then there is someone here in the whole pool of retail investors thinking that, okay, it was at 20,000, he's selling it at 19,500. Okay, let me buy. See, when there was high supply and less demand, the price actually went down. Now, what drives this demand and supply? It's nothing but market sentiments. I'll again give you stories and examples here. Say, for example, Jignesh Bhai's company has a strong foothold over Jamshedpur and the state Jharkhand. Now, there is no Reliance retail there. There is no Reliance Fresh supermarket there. There aren't any large organized player in Jharkhand. Just an example. There might be. So, then comes a news saying that Reliance is going all in on Jharkhand. They are planning to open some 100 stores in Jharkhand. Won't investors be a bit sad hearing this news? They'll be sad, or they'll be worried that, okay, Jignesh Bhai's major business is happening in Jharkhand. Now Reliance Retail is getting in there, opening a lot of their stores. So now market sentiments around Jignesh Bhai's business is bad. Because of that reason, demand can go down and supply will be so much and share price can go down. Or in another case, maybe there are news going around in the market saying that Jignesh Bhai has hired a new CEO who is a top-notch CEO. He has also hired some top quality people in the team, and all of that team is going around the country and also going internationally, planning to expand Jignesh Bhai's business. When the market hears such a news, there is good sentiment around the stock. So there would be high demand. People would love to buy Jignesh Bhai's stock, but there will be limited supply only. And when this happens, price will go up. I hope you understand the logic really clearly. Now that you have understood how stock prices are determined and how they keep changing, the next question is, why do they fluctuate every single second? So before getting into why do they fluctuate every single second, we have to understand why at one moment the share price is 20,000 rupees and the next moment share price gets updated to 20,100. What is the actual share price that we see on the screen? It is nothing but the last traded price. It's very literal. You can understand it. The last traded price of a share is its value. So initially it came out at 20,000 rupees, and later one person sold the share to another person at 20,100 rupees. Now what is the new share of the price? 20,100. Then this new person goes around and sells it to another person for 20,150 rupees. Now what is the price of the share that you see on the screen? 20,150 rupees. So when each trade happens in the market, whatever is the price of the last trade, that becomes the value of the share. This is a very important concept. Now let's address our point. Why do share prices keep fluctuating every single second in the market? Let's take an example of a Reliance or a Tata Motors, anything. The value changes every single second. Why? It is because of the sheer size of the stock market in India, the scale of the stock market in India. So the Indian stock market is so large that in a stock like Tata Motors, every single second trades are happening. So in every single second since trades are happening, its price, just for all the reasons that we discussed now, it gets updated every second. I hope you understand that as well. So if you have understood so much, I know there is so much, the video is becoming long. There is a lot of information bombarding which is happening, but please stay with me. Listen to this carefully. Take a break if you want, then watch the rest at a later time, but make sure you watch this completely. I hope I'm not boring you as well. When we get through this, I'm sure you'll understand everything that is to the basics of stock market. Okay, now it's time to get more serious. So far, we took this for granted and we said that, okay, a company comes into the stock market, does its IPO, and people are just going into the stock market, buying the stock, then someone else is coming and buying from this person. We just took all this for granted and we discussed that as if this was very, very simple. As if someone can just walk into the stock market and say to the stock market, okay, I need Jignesh Bhai stock, and the stock market getting the stock from someone else and giving to us. You felt it's as simple as that? But no, I was just taking that route so that we can understand the whole picture very clearly first. Now let's get a bit more into the technicals or into a bit more depth and understand how the stock market actually works. Okay. Now, yeah, say there is an investor, he wants to buy Jignesh by stock. Supermarket stock. So he wants to buy that. How can he do that? Can he go to the stock market, the actual NSE or BSE, and ask NSE, okay, I need the supermarket stock, please give me one? He cannot do that. For doing that, he has to go via a broker, a very, very, very important participant in the whole world of stock market. So basically, we are getting into the next segment where we are going to learn everything about the next participant in this world, which is brokers. So brokers are nothing but intermediaries who facilitate transactions in the stock market. As I said, no one can go and directly access the stock market. If someone wants to buy a stock, he has to go to his broker first and tell. Then the broker will, if he has to buy, the broker will find a seller and then facilitate the transaction. So broker is an intermediary between all the stock market participants and the stock market where the actual transaction happens. So again, we can go through a bit of a history or a story here. In the initial days, if someone wanted to buy a stock, he had to go to a broker physically and tell the broker, okay, I need this stock. Then the broker would go around the market. Broker would actually get into the stock market. He would go around finding a seller. If the broker finds a seller, then the broker facilitates the deal, gets the stock from the seller and gives it into the buyer. Okay, this used to happen earlier. Then technology evolved a bit. Then what happened? All these things started happening over telephone. Then an investor can sit at home, call his broker and say, hey broker, I want the stock. Then the broker would again probably go to the stock market, make some phone calls again and find a seller and then will facilitate the transaction or will get the stock for us. Then technology evolved again, which is today's age and time, right? Today, what can we see? It's all technology and internet-enabled brokers where they have web platforms, they have mobile platforms, mobile applications where we can sit at our home and within our fingertips, we can buy and sell stocks within seconds. It's as easy as that now. So why do brokers do this? So brokers stay as intermediaries and facilitate all transactions and they charge a small brokerage amount doing this. Okay, that is their benefit in doing this. So what is really important to understand here is our activity in the stock market is to either buy a stock or sell a stock or to make some trading, right? Trading activities in the stock market. So it means that it is absolutely necessary that all of us should be working with a broker. Okay, we should open an account with a broker. Only then we can participate in the stock market. Very basic, right? Without a broker, we cannot access the stock market only. So that is where I would say there are a lot of brokers out there, but it is very important to intelligently understand and analyze brokers and select a broker. And again, with all my experience in the stock market, let me say this, you cannot just participate in the stock market with just one broker. You might need one broker for your long-term investment activities. You might need another broker for your intraday trading activities. You might need another broker for your futures and options trading because each broker offers different services and features. So it's very important in the initial days for you to select a good broker. So I personally use Zerodha, Upstocks, Fires and Grow. So these are 4 broking accounts that I have, but it's up to you to compare different brokers and open a good broking account. So what I've done for you, I've made things very simple for you. I'm giving a link in the description and comment box below. You can go to that website. You can do a fair comparison between all the best brokers in India today. And from that website itself, you can open an account with whichever broker is of your choice. And if you open an account from that website, you're getting some exciting rewards as mentioned in the website itself. You can see what the rewards are. And if you open an account, you'll be getting all those exciting rewards and offers. So one thing is we have started learning anyway. So make sure that you open an account very quickly so that by the time we learn in the upcoming videos, you have your account ready and your investment and trading ready. So when you're opening an account with a broker to access the stock market, there are some logistics that you need to understand. That is what we'll see in this page. Basically, you are going to a broker, opening an account for accessing the stock market. Correct? So when you go to a broker, by default, you're opening two accounts with the broker. What are those accounts? One is a demat account. The second is a trading account. You should understand what these are. Very interesting concept. So demat account is opened with a broker or through a broker, and whatever shares you buy are held in your demat account. So it's necessary for you to have a demat account so that the shares you buy are digitally or electronically saved or stored in the demat account. Let's go back to the olden days. In the olden days, if you wanted to buy the share of a company, you had to contact a broker. The broker would buy the share and would deliver the share certificate on a paper to you physically. This is how things were. But it was very difficult to manage that, right? Because it was a paper form, a physical share certificate. You could lose it. It could go into a fire, right? It could get wet. Anything could happen, right? Or your signature you put on the share certificate, they might say there's a signature mismatch in the future. A lot of things were not right with the system. That's where the Indian stock market evolved itself and got into the completely digital and electronic state which it is currently in. That is where a demat account came into picture. Demat is basically dematerialized account, right? Share certificates got dematerialized and started existing digitally or electronically. So when you are going to a broker and opening an account, you basically get a demat account. Also, you have something called a trading account with a broker. Basically, both comes clubbed. It's very important for you to understand. So, trading account is where you put in your money. Okay? So, you have to have your money with the broker and you have to give money to the broker so that broker can give that money to the seller and buy the stock for you. Correct? So, you have to put that money in trading account. Now, how do you fund your trading account which is with the broker? You have your life's money in your bank savings account, right? So it is in your bank, in your savings account, you have money, correct? That money, you transfer it into your broker's trading account via net banking or even UPI today. So when you transfer the money in the trading account with the broker, in your broker's application, you can see that, okay, you have so much money. That money, say you transfer 25,000 rupees to your trading account, and then you want to buy a stock worth 25,000 rupees. So you pay that 25,000 rupees to the broker. Broker pays the 25,000 rupees to the seller who is selling the stock. He buys the stock for you. You get the stock and the stock goes into the demat account. The stock is stored in the demat account. The money for the transaction is stored in the trading account. I hope you understand this logistics very easily, because going ahead, you have to know this for making transactions in the market. Right. So we have already covered a lot about the basics about the stock market, how it works, why it exists and everything. But when we discuss the last thing, which is our stock gets stored electronically in the demat account. And I said, you get a demat account when you open an account with the broker, you might have a question. Is my stock, which I buy, is it actually with the broker? In that case, if the broker runs away tomorrow, he's basically going away with my stock, right? No, don't worry. So basically your demat account is not safely held by your broker, but your demat account is held with your depository. Okay, now that is where you have to look at this new red box, which is the next set of participants. I wouldn't call these participants a single name. Let's just call them facilitators. Because when all of this stuff is happening in the market, there are a lot of small jobs to be done. So all of those small jobs are done by these different participants. So since we came into the discussion talking about depository, let's just talk about depository here. So when you open a demat account, that demat account is not securely held by your broker, but that demat account is securely held by your depository. And who runs depositories? Is the Indian government, right? So you can have complete trust on depositories. So there are two depositories in the country. One is CDSL, Central Depository Services Limited, and then we have NSDL, National Securities Depository Limited. So depository is where your demat account is held, so that it's super safe. Your broker cannot basically take your stocks and run away. So just like that, there are other participants as well. So for the matter of this video, I wouldn't probably get into the details of each participant. If you're interested, you can read up more about them. Even if you do not understand the nuances of what exactly each of the participants do, it's okay. You can still participate in the market. You understand how it works. You can still make money from the market. But we cannot end the video without talking about the big brother here, right? So I hope you have seen this name somewhere. You already are familiar with this, or you at least saw this big written largely right from the beginning. SEBI, Securities and Exchanges Board of India. SEBI is nothing but the watchdog of the Indian stock market ecosystem. So let's be real here, right? We are talking about stock market, where a lot of money is involved. Huge companies and corporations are involved, and lakhs and crores of people are coming and putting their money in to make more money. What is stopping from people in not being greedy? People would be greedy, right? And when people are greedy and when money is involved, when huge money is involved, people tend to go via some bad routes, right? Make some bad decisions to cheat people, to trick people. People will definitely do such things, right? So there has to be a watchdog for this entire ecosystem to make sure that nothing wrong or bad is happening in this whole world. And that's exactly what SEBI does. So SEBI is again a government organization. It's set up by the government to make sure that no wrongdoing happens here. Otherwise, it's very easy for some bad companies to come and list their shares and raise money from the investors, and then the company might not be good enough. They have raised the money and they can just run away. So stuff like that can happen. And then there can be, I hope you have heard about operators and people who are pumping up some stocks by putting in money and causing troubles to other people. So a lot of such bad things can happen in this place, and it is the duty of SEBI to make sure that this whole world is functioning properly. Nobody is cheating anybody and things are in place. So that is SEBI, and it is for this reason why we can actually come into the world of stock market with a lot of confidence and put our money there, because our trust is on the Indian government. Our trust is on SEBI that no wrongdoing will happen here. Our money is not going to be lost, right? So this is what we had to discuss here. So again, if I may recollect the objectives of this video, first thing what we should have understood is why stock market exists in India. That is clear, right? Companies have to raise money, people have to grow money, stock market exists. Then we had to understand what is the stock market, right? We understood from the whole story. We even know Jignesh Bhai and his company and the whole story now, with which we have understood what is the journey in the stock market and how each participants benefit from it. And the last thing we wanted to understand was how does the stock market work in India? And now we have a basic understanding of how the stock market works. Now that was the intention, the agenda, the objective of this video. Again, I said this in between as well. Maybe this video have gotten very long, but I'm sure if you watch this, as I said in the introduction, with a lot of focus and intent and effort, you can easily understand this. This is no rocket science at all. You understand this because in the coming videos, we are going to touch upon everything that is there to investing and trading, fundamental analysis, technical analysis, everything. So be prepared is what I would say. So as always, if you have liked this video, make sure that you smash that like button. I would really love to say this here. In Malayalam, which is a very small language, I've done a similar video and that has already racked up more than 2 million views. Such a small state, right? So absolutely looking forward. Share this with as many as people as possible. Invite them to join our learning journey. Invite them to join our community. And hey, if you haven't joined our community yet, to join my exclusive community on MarketFeed app, I'm sharing the link to join the community also down below. So yeah, that's it from my side for today. So if you haven't subscribed to the channel still, make sure that you subscribe to the channel and share the video with as many as people as possible. So let's learn, trade, invest, and grow together. Meet you in the next episode. Bye-bye.